This is Tom Asprey with the Viper Report Market Wrap video for January 10th, 2025. New year, and the action this past week suggests we're going to be a roller coaster in the first quarter of 2025. That was not the case at the start of the week, as there were some encouraging signs that the correction had gone far enough. That was clearly not the case. It was a pretty rough scorecard, led in the downside by the IWM, the small cap index, down 3.4%. Utilities didn't do much better, down 3%, and then roughly 2% losses in the Dow Industrials, the NASDAQ 100, and the S&P. The transports escaped some of the selling. Gold shares had a good, strong close, up 2%. This weekly chart of the NYSE Composite shows that we have closed down 1.5%, a little bit better than the S&P and QQQ, but now clearly below the declining 20-week EMA, which is at 19,327. Typically, this moving average is a good level of support, and the Stark Band equivalents are down here about 400 points below where we closed, so that corresponds with the highs we made in both April and in May. More important, on the AD line analysis, the NYSE stocks only now in a clear short-term downtrend. It's reached next support here, but it needs work before it'll turn back to positive. Most alarming was the NYSE All. As of the close a week ago, we flipped back above its moving average. I've been using this indicator since the 80s, and typically that's a 60-40 shot, that the correction is over. Of course, that was not the case, as the breadth was quite negative last week. This is shown in this favored table from the Wall Street Journal. 651 up, 2197 down, and many more new lows and new highs. The NASDAQ not a little better, but not much, and also showing a surge in the number of stocks making new lows. A closer look at the daily charts may help us determine where we are now and how we got here, as we're potentially heading. This goes back into the August-September period. Remember, we peaked out in July here, had a very sharp decline by early in August. Everyone was ready for even worse in September, but instead the market turned higher. You can see that the AD lines broke out to the upside here in August. The S&P 500 AD line cleared this resistance. The stocks only was lagging a little bit, but the NYSE All was doing a pretty good job by the middle of August. Therefore, the sharp decline at the start of September, based on the well-publicized horrible seasonal outlook for September, caused a pretty sharp setback, but the moving averages held support and back off to the upside. So it's a pretty some wild swings going into the election. The AD lines moved into the corrective mode on December 10th, this vertical line here, as they dropped below their moving averages. In my work, it's important to notice that all the AD lines did make new highs with the major averages. So heading into last week, we had some potential bottom formations that have now been aborted. You can see the support here in the S&P 500. This little dashed line was broken. A resumption of the downtrend in the stocks only, and also in the NYSE All. So, here's where we start looking at support levels for the AD line. But clearly, once we have this peak and this peak, that'll develop a downtrend that will need to be overcome in the first quarter before the correction is over. This weekly chart of the S&P cash shows the reversal bar here with a 115-point decline, closing right on the 20-week EMA. The Stark bands here are at 56.86, which is about 3% below the current close. This level also corresponds to the high we made in July. Remember, once you take out a prior high, that level of resistance then becomes support. So I would look to see some, some buying down at this area if we get there. 2.5%, not much of a decline after last week's action. You can see the AD line down here has dropped below the lows we made in September. So that reaffirms this downtrend here. Major support going back to the April level, quite a ways below where we are. There's also longer term support at 52.70, which I would not expect to be tested during this correction. Correction, not a bear market. Got a fair number of emails, etc. I'll be doing a video on a recap of the 2007-2008 bear market and why the current situation is not the same. This is a longer term chart, shows you this little box here, shows you the monthly AD line started diverging from prices in 2007 peak and then dropped below its moving average, which started to decline. As of when December closed, we're well above the moving average here and show no signs yet of dropping below it, though that certainly is always a possibility. But no divergences, which is more important. The daily chart shows you that the daily Stark band now is at 569.46 with the 38% support at 565, 50% at 551. You can see the AD line here does look pretty negative and looks ready to test the support from the September lows, if not the support from the August high. As for the QQQ, it's still above its 20-week EMA, which is at 501.28. Then we have some support down here, which is in the 483 to 485 area. The weekly AD line has dropped further below its moving average, and the moving average is flattened out. So that will bear watching. Should we actually make a new high in the next couple of weeks, there's the potential to form a negative divergence here because of the AD line is well below its prior high. So, and as we'll talk about a little bit, there's some more signs of deterioration in my Teflon sectors, particularly the XLK. Down below here, we can still that the QQQ is still outperforming the S&P. So it's still a market leader. So in a correction, you would expect it to decline less than the S&P, and on a rally, you expect it to rally more. Of course, the stock market has been hurt by the sharply higher yields. Last week, you can see we closed at 4.776. And everyone's looking for a move to the 5% area, which would not surprise me. But this close, was above the weekly Stark bands, which for next week will be 4.88%. Weekly studies, we had that pullback here, held a 20 period. I was expecting it to break below that, but once again, the weekly MACDs were telling a different story. And so it still looks higher. If you look at what I am watching for a change in that is the 2-year yield chart, showing that it's been lagging here and still in a downtrend. MACD is positive, but much less so than the 10-week or the 10-year T-note yield. So we'd need pretty much a drop back below 4 0.10% in the 2-year to suggest this rally was over. In last week's video, I commented the fact that the correction camp started looking a bit crowded, and that suggested we could see the buyers roll into the market. That was obviously not the case. You can see the sentiment survey from AAI shows the bullish dropped even further to 34.7% last week. You can see that as the daily technical studies like the AD line turned negative in early December, the sentiment peaked at 48.3% and it's been declining ever since then. So with last week's action, it'll probably drop below 30% this week, and we could, it's not this reading on sentiment does not often coincide with a market peak or a market low, but it does show you the trend. For example, if you look back into what we saw, in the summer, we hit 51% in August. Sharp decline first 2 weeks, got down to 29.8, then resumed its uptrend. So it can tell you a change in what people are thinking about the market. So I would look for, with this week's action, you're looking probably for at least 2 to 3 more weeks on the downside. We'll be looking at new downtrends connecting these last peaks in the AD lines for signs of a turn. The daily outlook for the QQQs also got more negative. You can see we had that rally back up just before the end of the year, peaked above its moving average, its declining moving average, and actually hit some resistance levels before it turned lower. So the current chart suggests that support around 500 and the daily Stark band, as well as the monthly S1. AD line still in a pattern of lower highs and lower lows, with next support going back into the October lows. Daily RS also still positive. As we mentioned, the weekly is as well. So that'll be interesting to watch in the next couple of weeks. Selling was moderately heavy on Friday. 72% of the S&P stocks were lower. 70% of the S&P 1500 and 74% of the QQQs. Not as bad as we saw a few weeks ago, and these very oversold readings I thought might have been enough to complete the correction along with the decline in bullish sentiment. Obviously that was not the case. Some of the other indicators turned a little more negative for stock market last week. That includes the VIX, which peaked up to 1954 in a very starting of an uptrend here, but still at relatively low levels given the price action over the past week. So, but you have to look at this as both in now and shallow uptrends. The question becomes, are we going to turn into something like we saw in July, and a spike up to that 30 plus level in the VXN, or up to above 27 in the VIX? Time will tell, but you can see we're awfully close to the lower Stark band. So if we get a spike up in the VIX and a drop to the daily Stark minus bands, it's probably more likely a short-term low than a continuation signal on the downside. Not much of an increase in the put-call ratios. You can see, still below 1 on the total put-call, and the index is 1.21, so 21% more puts than calls. The high-low analysis has turned more negative. You can see a sharp spike in the NYSE new lows to 233 and only 29 new highs. So, we broke out above this in December, which turns out to have been a pretty good early warning sign. So we'll be watching. Likely that this 233 level will be exceeded in the next couple of weeks. And so for now, this also points lower. Similar action in the NASDAQ composite, 295 versus 70. we had been diverging for a while. So when we make it up to the plus the 600 level that we did in August, we'll see. Let's go to the sector report. Lots of important changes in the past week here. You can see a number of weekly sell signals, everything from QQQ, SPXL, that's the triple leveraged long, SPY, the TQQQ, which is the leveraged long Q, as well as the Vanguard Information Technology, XLF, XLK, AIQ. New buy signals, pretty much either gold or on the short side, SPXS and SDS. More interesting, and now only 27.5% are above the quarterly pivots. Growth gauge, at 60, but you can see that only 50% are of a weekly positive DTS, and the value, only 18.2% are above their moving average. Those are the energy, XOP, and VDE. Short is still, quite positive, 66.7% above the quarterly pivot, and 66.7% with a weekly DTS. All red on the inverse and leveraged long. In the weekly summary report, just going out the next couple hours, points out the number of sell signals. Also interesting, the big correction low in October of 2023. That's the one that started in July and ground out, to a turnaround the end of October, early November. That market gauge got to 15.3%. So gives you a little perspective. You can see, this chart here of the SPXL, shows, a trading range here. It turned negative on the 18th of December, and next major support, is in the 156 area. That's 4.2% below Friday's close. Of course, this is a triple leveraged S&P indicator, so that means that the regular S&P probably is not going to see that big a drop. Lots of negative, not many positives. XLE last week, up to 33%, are positive, but you can see industrials, discretionary, we got stopped out of that now, fortunately. Conservative XLP is acting a little better. One surprising one is XLV Healthcare at 41.7, but none are below or above 50% at this point, with 0% in XLU and 9% in XLRE. XLRE was the weakest, down 4.3%. XLK lost 3%, and all the rest of these, XLP, XLY, XLC, and XLU, were all down more than 2%, and were weaker than the S&P. That's the important part to note. We look into sort of the big picture here. You can see not a lot of green, I should say. XOP gave a 3-day positive DTS signal, and its DTS was already positive, so now we're just looking for the weekly DTS. The AIWQ, that's Jerry's modification of the RS analysis, is showing green still for IWF, cloud, XOP. In terms of positive 3 DTS signals, only SMH and XES, another energy ETF, have positive signals. SMH is positive weekly, as is VBK. That's a small cap favorite of mine, but overall pretty bleak. If you look down a little further, you can see that our current positions, most of them got hit pretty good. We will go into the stops in terms of Monday's report. More interesting, I thought, was these developments in the RS graphs in the sector report. You can see that the technology has dropped back below its slow line here. Reverses the positive signal here and suggests that things like XLK may have problems over the next couple of weeks. It may see more selling than some of the other ones. Also, it looks like the XLC is reaching a critical level. It's closed just below its slow line, but doesn't necessarily really has to violate this low to indicate a new downtrend. There were some other interesting changes in the RS analysis. Energy appears to be bottoming in here, and so we're looking for a good entry point in XOP. We should see a contra. If growth gets hit hard enough, we should see energy, a value play, give up some of its recent gains. Materials still looks bad. Industrials, yes. As I mentioned, consumer discretionary also appears to have topped out. One reason we raised our stops there, so we're out of that position. Consumer staples still in a downtrend. Healthcare, it's been negative, pretty much all of 24. Now starting to look a little bit better. We'll discuss the daily outlook and what that tells us about a potential entry point in Monday's reports. Financials making me a little nervous here. We have big bank earnings on Wednesday, so it could certainly go either way. Only 27.3% are bullish. Of those that are bullish, Bank of America, looks to be the strongest, with everything from 4-hour, daily, 3-day, and weekly positive. Wells Fargo just has the 3-day and the weekly positive. Same thing for J.P. Morgan. If we look down here, technology, Cisco is one of the few things that looks positive. Communications, Meta's still holding on to it, but if it starts to roll over, that'd be more negative. Utilities, we did recommend some utilities, and we're still in that position, but its relative performance looks like it's trying to bottom, even though, as I pointed out at the start, it had a 3% decline last week. So there's a few utility stocks that appear to be bucking the trend. So I'll be looking to see if we get more 3 DTS signals this week, to see give a more healthy signal for that market. Busy week for economic data. We get the producer price index on Tuesday, followed by the CPI on Wednesday. That's along with bank earnings, so it'll kind of be the double whammy by about 8:30 on Wednesday morning. That'll be interesting. If the market declines into that and gets below the daily Stark bands, we could see an upside reversal, but that's not going to be enough to change the corrective trend. Empire State Manufacturing, some of that data has been stronger than expected. That's why bond yields have gone higher, and also why stocks have been under pressure. Of course, the longer term aspect of this is that economic data does look quite strong. That suggests that certainly earnings estimates in 25 are likely to be better. Earnings data, rather, should likely be better than expected. And so we get a bunch of Fed governors speaking on Wednesday. Then we get retail sales on Thursday, as well as Philadelphia Fed manufacturing survey. And then Friday, housing starts and industrial production. In summary, I see no signs of a major top, just an ongoing correction. Could last a couple to 4 more weeks. This weekly chart shows you where I'll be focusing. This is of the spider. Shows you the ugly action last week. The 20-week EMA is declining, and the Stark band's down here around 567. More importantly, the yearly pivot is at 553. That's quite a ways below where we are now, but I think those yearly pivots in a number of ETFs will provide a good level of support, and will be an area where we'll be looking to add to our long positions. If you have any questions, email me at tom@viperreport.com, and for a free copy of the T&J sector watch list, send us an email. Thank you very much.